Hey traders, this is Blake Morrow with Traders Summit. And with me once again, I have Larry Tentarelli from Blue Chip Daily. How you doing, Larry?
Blake, I'm great. Thank you. Thank you for having me on. How are you?
I'm doing well, and it's nice to have you back. I know time passes between the time that you and I get to sit and speak, but a lot's changed. Obviously, the markets have been under pressure. We've seen the S&P, it's trading right around the 4,000 level. We got inflation data coming out tomorrow that could impact the markets. We just got past the Federal Reserve. The Fed's on a little faster path now to raising rates. So, when you and I spoke last, you were really noticing the weakness in names like ARK, ARK Investments, ARKK. And it's continued to weaken. And then you were also noticing that commodities, you were looking to buy some pullbacks in commodities last time we spoke. I guess the question to you is, first of all, great job noting the ARKK move lower.
Thank you.
I guess the question would be, are we near some support there? But also, have commodities pulled back to a point that you're looking to buy them? What are your thoughts now with the current market environment?
So it's very dicey. I've got a lot more cash than I usually have. So I was just looking through my numbers. Right now I'm at 60% cash. I've got a 10% index downside hedge, and I've got a little bit less than 30% long. So I'm 20% net long right now, and mostly cash. There have been some the charts are weaker than I'd like to see them. The S&P made a lower low yesterday. NASDAQ 100 made a lower low. They're just weaker overall. There's really only three parts of the market that I see holding up, and we'll go through the charts, and that's energy, consumer staples, and healthcare. So that's where my long positions are concentrated right now. And then I've sold out of everything else.
Well, that's what it's interesting. Interesting you say that. Energy, I gotta as a consumer, I've gotta go there. Consumer staples, well, I gotta survive, right? And what else did you say?
Healthcare.
And healthcare. I gotta pay for healthcare. So I mean, maybe there's a few bright spots, but are the markets getting to levels where you're starting to find things as being attractive? Because this is a pretty key level of support. I know a lot of people are starting to think, does the Fed maybe not be so hawkish now? What are your thoughts there as far as where we're at in the markets? Are you starting to fish around for some deals?
Not yet. Because the problem is the downside momentum is so strong. You see, I'm not a good counter trend trader. I look more for strength, shallow pullbacks, and I'll go through some of the charts, that I am interested in.
Yeah, let's see them.
But as far as the markets overall, I'm more cautious here. I think there's two potential catalysts. If for some reason bond yields were to pull back sharply, and maybe tomorrow's CPI, if the CPI comes in lower than expected, that could be a catalyst. And if you want, I'll jump into my charts.
Let's do it. Yeah, I think that's and while you're pulling those up, I think that's what most traders are really looking for. And let's get a signal from that the economy might be stabilizing because inflation's not so hot, and that would be the reason to really start looking around. So I'm interested to see what you got here.
Okay, so we'll start, and I've got a bunch of charts lined up for you, but we'll start obviously with the indices. So where my concern is right now, so keep in mind, I don't trade counter trend, short term, day trading, anything like that. So anything that I talk about is going to be the primary trend that I see on the screen, but that doesn't rule out short term bounces. But right now with S&P, where my concern is obviously it's testing a lower low as we're speaking, 39.58 today. So there is some support on the chart at 38.50. But for my time frame, I don't like to see this pretty much waterfall pullback below 4 declining moving averages. So where I want to stay, and I'll go into a group that I'm in right now, a little bit weaker. Oh, hold on.
And while you're pulling that up, what are those moving averages that you're looking at? If you can just kind of scream them out, that'd be great.
Sure. I use the 20, 50, 100, and 200 SMA.
Okay.
So I keep things fairly simple. I don't use EMA. Over time, EMA and SMA test out about the same, but EMA is better for shorter term traders, day traders, swing traders, things like that. So I'm going to move, I've got you up on my screen, so I'll move you down here a little bit. But so where I want to focus on right now, my biggest concentration is in energy. So energy XLE, it made a new high on Friday. Now, yesterday it had a really sharp drawdown. It was down about 8%. I was not happy to see that. But in the meantime, as long as this chart stays over 70, then that tells me that this uptrend is intact for now. So I've got 4 rising moving averages, the 50-day, the 100-day, the 200-day. 20 days a little bit weaker, but keep in mind, XLE last week, it made a new high, and it was up 10% on the week, in a week when the S&P made a new low, NASDAQ made a new low. So I do expect some volatility, but the energy sector is where my biggest overweight is right now. Some other charts that I think are set up well. So we talked about consumer staples. So Kraft Heinz pulling back today, but if we take a look at it, it made a new 52-week high today in a down market. And if we dial out to the longer term chart, I'm going to dial up the longer term chart just for a minute here. If we go to the monthly chart, you can see that where it's at right now, 43.44, it's trying to break out to 3-year highs. So it's trying to break out of a resistance level in a market that's been very weak. And we can see today the volume looks fairly 4 million shares. Right now we're at 20 after 1. It traded, it looks like 9 million yesterday. So it looks like it's just pulling back for now on more shallow volume. But that's a chart that's set up well. We talked about healthcare. If we take a look at stocks like Bristol Myers. So now here's the thing, Blake. These are not exciting names. This is not 6 months ago when we were talking about AMD and we were talking about Alcoa, and we'll take a look at some of those charts. But what's been working in this market, and I talked about this the last time that we spoke, what's been working in this market is, and I'm going to move you up a little bit here, but what's been working here is lower volatility stocks, because lower volatility stocks tend to work better in a higher volatility market. And the reason is that a lot of money managers, a lot of fund managers have a mandate that they have to stay a certain percent invested. So you and I, as private investors, if we want to go to 100% cash, we can. If we want to go to 50% cash, we can. Most fund managers, mutual funds, they can't go 50% cash or 100% cash. They have to stay, X percent invested in the market. So in high volatility markets, what they tend to do is look for lower volatility positions, so that if everything pulls back, they want to have the more shallow pullback. So if you take a look at a stock like Bristol Myers, and we may have looked at this before, but it's leading year to date. It's trading right now over 3 rising moving averages. It's very close to breaking out to new highs. And the key thing, it's got a big dividend yield, 2.7%. Forward earnings, which you can't see here, but forward earnings are like 10 times earnings. So that is a lower valuation, high dividend stock. If we take a look at Merck, 15 times earnings, 3% dividend. But once again, if we see where it is on the chart, now one of 2 things can happen here. Because if we look at Triple Q has by far has been the weakest link. And I will say that they got me on this head fake here. I did buy into that, and I got reversed out of it. So Triple Q had been going down. Once I saw Triple Q take out the February highs right over 370, I started to go long in here, coming over the 50-day. I took some positions in Microsoft, Nvidia, and I took a position here in Triple Q. And right after it made this new high, you see, for a lot of trend followers and technical traders, this high at 371 which took out the February highs, for a lot of us, that was a buy signal. It cleared the 50-day, it cleared the 200-day, it made a higher high versus February. And for a lot of people, this area in here was a buy signal, and then they just took it straight back down. I think one of the Fed governors, Lael Brainerd or somebody, came out with some very hawkish statements, and they took it right down. But this has been a very sharp move lower in triple Q. It's taken SPX down because S&P is 25% technology. And just a lot of these charts, you know, when we look at Amazon, these are not good charts for me.
Yeah.
There's just nothing in this chart. Now, here's what I will say. If tomorrow we get a surprise and the CPI, I do think inflation has peaked. So I think it's peaked.
Okay.
So when we hit 8.5% year over year a couple months ago, and that was the highest reading in like 40 years, I do think we're going to look back and say that that was the high water mark. So now inflation's still high. The Fed wants it at 2%. It's 8.5% right now. But what I think we'll see is if inflation readings start to come down from 8.5 to 7.65, whatever it is, I think that could help the markets, but it's still going to take some time. But when I see the leaders, so Amazon obviously is a leader, Microsoft is a leader, but from a technical perspective, if you're a technical trader and you see a stock like Microsoft breaking below this 270 to 275 support level, there's just not a lot of strength right now. They could reverse at any time. But for me right now, I'm much more cautious. I want to see the charts that are in this upper right-hand corner. And, there's just not too many outside of healthcare, staples. It's very defensive groups. When we look at AMD, which has been one of my favorite stocks over the years, and keep in mind, I'm not negative on tech. There's just no charts that fit my process right now. I'm a trend following trader. I like to stay with the primary trend. And while any of these charts can bounce at any time, you can just look at that chart. It's a downtrend. And that's why right now I have no tech weighting whatsoever.
Well, you follow a lot of just basic technical analysis, which for the record, traders that know me over the years, I adore that because you don't have to make it complicated to trade, to invest, to make decisions in the market. Keeping it very simple as far as technical analysis goes, I think is one of the benefits of actually listening to somebody like yourself. But the fact of the matter is, and what you're pointing out is, there's just not a lot of leadership in this market, and hopefully maybe the CPI data may change that story, that narrative a little bit. Can we take a look at the broader markets with you, Larry, and just take a look at how you're viewing, let's just say, the S&P and perhaps I know we looked at the NASDAQ, but maybe the Dow and some of those other bigger indices.
Yeah, we'll walk through. So this is something that I walk through with my website members every single day. So every night after the close, I do a markets video. So I'll take you through the key indices. So S&P 500 right now. So that the biggest concern I've got with the S&P is I've had to keep lowering my support lines, and that's not anything that you want to do. So before, when 4,200 to 4,250 was support, I've had to lower it down. So for the S&P right now, here's the good news. So the good news is that 3850 to 3950, if we take a look at the S&P chart going back to February and March of 2021, you can see there is some congestion in there. But I would imagine if we get there, and we're very close, 39.58 today. So the good news for S&P is we are coming down to some congestion in that 38.50 level that I think could present some longer term support. Okay. So here's the thing: if we get the S&P to longer term support and we get any good news from CPI, anything like that, bond yields, then I think it could provide a lot of support for us. If we go through, let's do, there we go, view all. So that's S&P. So SPY obviously is going to be the same thing as the S&P. So the NASDAQ 100, if we take a look on the chart, 12,000 is the big number. David Tepper just came out and said that he covered his triple Q short, and he thinks that 12,000 is going to hold on NASDAQ. But if we make that chart a little bit bigger, because this is the key market. So the good news for NASDAQ is at 12,000, there's a lot of support if we look at this chart. So this goes back to 2020, 12,000 and 11,000 beneath it. So in this range, 11,000 in 2020, 11,000 here, 12,000. So we're getting down longer term into a key support level for the NASDAQ 100 as well. So while the selling has been pretty fast, there, I think that there's some hope if these levels can hold. If we take a look, we'll go down to triple Q. So, and you can see I already have my support lines drawn. So 295 on triple Q. Right now it's at 300, but 295 held here. And then it was a resistance level here, here, and here. So once again, you can see we're getting into some real support on these charts that I think could at least slow down any type of decline. And possibly, if we get good news, because we'll take a look at bonds for a second. So the Dow is holding up relatively in line. Small caps have been very weak. So I don't do a lot with small caps whatsoever. It's just not a focus for me. But obviously, when you see these charts breaking down, it's a little bit more difficult.
It does become concerning. You're going to look at bonds, and I was going to ask you, while you're doing this, how much is this bond move going to factor into your decision making?
Big.
Okay, and tell us why. Tell us why.
Well, because the bond market and the Fed tightening process right now is determining the moves, I think, in all markets. Because this bond yield breakout, if we take a look at when stocks started to roll over, so bond yields broke out March, we'll call it March 1st was the bond yield breakout. And then if we take a look at triple Q from March 1st, so if we go to March 1st on the chart in triple Q, big drawdown, a little bit of a rally, and then straight lower. So every single market that we take a look at, if we take a look at the S&P from March 1st, so it had a big drawdown, a big rally, but then as the Fed has started to tighten, it's taken stocks down. So I firmly believe, and we'll go back to bond yields for a second, but I firmly believe that if there's some pullback in bond yields for whatever reason, and there's a lot of speculation, a lot of Wall Street firms think that 3.25 is the high side on bond yields. We just don't know. And here's the thing. I don't try to predict the end of the run. So if we look at bonds right now, TLT has just been straight down. If for some reason there's a catalyst, and it could be tomorrow, if we get a weak CPI report tomorrow, and if the market starts to think, well, a weak CPI, maybe the Fed will take their foot off the gas a little bit. If that shows up in the bond market, I think that would be very, very constructive for stocks overall. I think this breakout in bond yields has put a ton of pressure on tech stocks. It's put a ton of pressure on tech stocks that don't make any money. These high price to sales stocks. Yep. And I think that the best chance that we have to get some type of rally in stocks is if for some reason bond yields take a break, then I think that it takes the pressure off the stock market. Keep in mind,
and you said, for tomorrow would be a good example. And by the way, if you're watching this, just keep in mind, you're probably watching it after the CPI data, but by the time you're actually viewing this, but you talked about CPI, how about if the geopolitical situation ramps up a little bit, bond yields come down because bonds are rallying from a safe haven point of view, then obviously your tone might be a little different, right?
It depends why they come down.
Yeah. Yeah.
It really depends why they come down. I think if bond yields come down from weaker economic data, I think that's the best case scenario, because I think what the market is scared of is that the Fed is going to tighten and tighten. And right now, the Fed fund futures market, the target rate right now is 1%. The futures market is pricing in 250 to 3% at the end of the year. So I think what the the golden goose is if economic data comes in lower, bond yields come down, the Fed, there's any glimmer of light, then I think that stocks get a nice reprieve. And I think, listen, I think there's stocks like, AMD is 17 times earnings. Facebook is 14 times earnings. Microsoft, I think, is 23 times earnings. These stocks are not overvalued on a traditional basis. Now, there's still stocks like Snowflake that are 40 times sales. That's a whole different story. But I think the really big companies, Apple, Google, Microsoft, they've got, their valuations are not extreme whatsoever. They still have some growth, but the market's been concerned about, possibly slower growth going forward. So as I said, I'm not negative on Microsoft or Google or anything. It's just these charts, as a trend follower who likes to buy uptrends and strength, there's just nothing in that chart for me right now. But I think a lot of these companies are pretty fairly priced.
All right. Well, with that being said, Larry, you talk trader lingo, and if I'm sure you probably, are the things that you say are ringing and resonating with a lot of traders. So if I'm at home, I don't know who you are. Tell us a little bit about what you do over at Blue Chip Daily.
Sure. So I appreciate that. So the easiest place to find me on Twitter. So my call tag is at LMT 978. I used to have Larry Tentarelli as my call tag, but nobody could ever spell it. Nobody could ever find me. So LMT 978. My website is bluechipdaily.com. We've got a 30-day free trial right now for new prospective members. But if they go on the website, they can see a lot about. I've made some very timely market calls. So I let members know about this market rotation back in December. I sold out of high growth stocks in the fourth quarter. So I got out of Netflix before it dropped 70%. I got out of Facebook before it dropped 50%. So it's very important. Capital preservation is more important than, what stock is going to go up tomorrow. Because if you've got 50, 60% drawdowns in your account, it's very tough to be there to recover when the turn comes in. And the turn could come at any time. As we're talking, I'm looking, energy's turning up, technology's turning up. I am keeping the faith. And even though I can't give you a lot of charts that look really good right now, I'm keeping the faith that maybe with these support levels coming in, I'm looking for the CPI genie to give us a good number tomorrow. But make no mistake about it. I'm defensive. I'm careful. I've got cash, but I'm not bearish. I just want to see, I don't want to see down every single day in the index. So I'm keeping an eye on a lot of ideas. I'm hoping that the CPI genie bails us out tomorrow, and then we'll look for more uptrends.
Awesome. Well, we'll keep the faith, brother, and let's get that genie back in the bottle. And I want to thank you, Larry, for your time. It's been great. It's always eye-opening. A lot of people get in the weeds with technical analysis, and it's really refreshing to see the basic charts and a basic approach to the markets. It makes a lot of sense to me. So, Larry, thank you so much for your time, and I can't wait to have you on the next time around.
Awesome. Blake, thank you so much. It's great to be here. I really appreciate it.
All right. Have a great day.
You too. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.